Welcome, and thanks for joining me today on Mortgage Manager Playbook, a podcast for sales leaders who want to improve their team's sales performance and originate more loans. I'm Pat Sherlock, your host. Today's topic is an important topic, how to get the most out of loan officers. And that's a topic every manager is facing. I have the perfect expert to share his wisdom in this arena that is so sorely needed, and that's Greg Sayegh. Greg is the co-founder of InGenius and a chief strategy officer for. Prior to that, he's had many years as a manager of production, Washington Mutual, Countrywide US Bank, and several others. Hi, Greg.
Hi, Pat. Nice to see you.
Well, I'm excited about this topic because I have these conversations every day, and I'm sure you do too. So I want to talk about, before we jump into it, how did you get into the mortgage banking world?
Great question. So, as a young guy, I was from a real estate family. My mother was a real estate agent and had been forever, and talked to me about real estate, and it's something I should consider. Well, I was going to college. I was playing baseball for that college, but I decided to get into real estate right after I turned 18, and I did very well. In fact, within about 2 years, I was making more money than my dad, and I ended up buying my family home, which was another story in itself. But what I noticed was the loan officers that I was doing business with were very professional. They drove really nice cars, and I thought the way that they approached the business as business people, not real estate agents, it really intrigued me. So I had a few conversations, and I ended up becoming a loan officer for a small bank in Los Angeles.
And that started the whole, many years later, right, trajectory. So that's fabulous. So I'll talk about the issue, since you've seen it both as on the corporate side and now on the entrepreneurial side. What are issues that mortgage bankers should be addressing that you don't think they are?
Thank you for the question. There's a few, and I'll be brief. The first one, I think, and this is a changing dynamic, is the role of the branch manager and the regional manager in some companies. And it seems like a lot more activity and responsibility is being distributed, and there's very little that seems to happen that's really at the enterprise level. Everyone's doing things a little bit different, it appears. So the question that I would have is, in that changing world, who recruits, who coaches and trains the loan officers? Who's driving accountability? Who's the coach? Are the goals of the branch manager, regional manager, are they aligned with the company? Or are they really looking to focus on their own geography without really thinking about the roll up? But that is a thing I see quite a bit. Branch managers now seem to be originators. So, who's minding the store? Who's managing the LOs? And are they getting developed effectively? I think that's a big topic, and I think that could be driving productivity challenges. Second thing that I see, and this is referenced in our numbers, is a historical 35 to 40% annual loan officer turnover. And we have a report at InGenius called Arrivals and Departures, so we can see what loan officers are joining companies, what's their production history, who's leaving a mortgage company, and what is their production history. And it appears that there's a sharing or churning of low producers that are just going back and forth between companies. And I think that is something that has to get solved. The cost of a new hire to onboard, equip a new hire, and is a big impact to the bottom line, but also the reputational risk that goes with it. We're in a unique industry in that everybody sees what the other companies are doing. So if a mortgage bank or a bank is hiring a bunch of low producers, that's very visible. And I think that high producing talent prefers to work next to high producing talent. And right. If we're hiring low producers, consistently, they know there's going to be some drag on service support and so on. So it goes back to, are you filling desks or are they strategic hires? And that's one I think has got to get solved. That's data going back about 25 years. And the third, and this is really important, I think, for the future of the industry, because the dynamics, again, the demographics are changing, is this home ownership gap with African American borrowers and Hispanic borrowers across the country. You know, if you compare lending patterns since the civil rights movement in the 60s, have African American home ownership, has it really improved dramatically to the point that, you know, when you look back, you could say, yes, those programs have been successful. So there's a lot of opportunity in that business. That's the future buyer are going to come from the diverse segment.
Well, that raises the big question, which I consider, and I'm glad you brought it up, is that you need a workforce that matches your customer base. And that's another topic unto itself. We'll have to have you come back and talk about it, because I think it's so important. And of course, this means that we can't really be looking at maybe the same type of loan officer as we did in the past. So I think this is a great time to kind of jump into, and of course I want to share your data that I find is mind-blowing, is that you show that 88% of the loan officers are doing 2 loans or less a month. And I want to have you talk about that. And of course, you've shown that data across really pretty consistently throughout 2023 and also now 2024. So what are your thoughts on that data?
Great question. You know, the data is a little bit skewed, only in that we know that 2023 was a significantly lower volume year than we've seen in the past number of years. But, you know, when you have that high of a percentage of loan officers doing less than 2 loans a month, they're certainly not profitable for the company, and companies that are already struggling with margin compression and high cost. And then you wonder, how are they making a living? So what is their stick factor? Are they going to be able to stay through this downward cycle and get back to, say, some normalized volume in the future? I have another statistic that really is reinforced with the data that we put out. I've been tracking this since 1988, and yes, I'm much older than probably a lot of your audience, but, you know, 1988 through today, with 5 top 5 companies, 3 being #1 mortgage lenders, and looking at their production, and I was blessed to be part of those organizations, 65 to 70% of the total volume, units or dollars, are closed by the top 25% of the loan officers. The next 25% close between 15 to 25% of the total. And the bottom 50% close between 10 and 15% of the total volume. So, and that's been happening since '88. So that just tells me that with all of the tools that have been provided, you know, technology, the tech stack, the lead generation programs, the internet, or where you can Google how to originate loans. You know, these are thousands of websites to tell you how to produce loans. With all of that, you still have that segmentation. So I look at that as a DNA more than anything, meaning there's a reason the lower producers are lower producers and the higher producers are higher producers. So when I look at how to, you know, what should the strategy be, or what should be considered, it's really manage them differently. Starting at the bottom, you know, looking at the bottom loan officers and saying there's some accountability that they should have for activity. If you're going to hire them, someone's got to own them. That's only fair for that individual. So what are the standards? Do they know they're expected to close 2 loans a month? Are they accountable for a certain level of activity? My teams in the past were really good at managing the activity of the low producers, and I know people hate that. Accountability, call report, however you want to do it, but you have to smoke out what the issue is. If it's a lack of activity, then that's maybe a motivational issue that, you know, is probably in their DNA. But if they have the activity and they're making the sales calls and they're coming back to the manager to say, hey, I'm beating my head against the wall with these real estate agents, then it's a skill set. And that's a lot easier to focus on, is a skill set. And so I would say I would micromanage my bottom 50. They got to prove they're worthy to be on the team. And if they're not able to do the things they're required to do in that job, you got to move on with no emotion. If you've been clear with them, you got to move on. And I can tell you, in my experience, there are some unicorns for sure, but the majority of those folks are probably not going to make it long term.
Yeah, I want to ask a question. When you look at the data that InGenius has about the 40% turn, is the 40% at the low producer level, or is that at higher producers are representing the who is moving from one lender to the next?
It's generally the low producers.
It's the low producers, right?
Right, and we see in our report, we show, and it's stack ranked by individual higher producer, historical volume, what the new company gained in terms of net volume history, and what the company lost in terms of volume history, and that you have a similar trend. If you may have a couple at the top that leave. That's rare. You've got some middle folks who are getting shown the love by the new company and make a choice to move, but the bulk of the turnover is in the bottom group.
Right, and I think most lenders, they ignore that fact, is that they're hiring basically underperformers from other companies and then hoping that their technology is going to make a difference. I hear that all the time from managers.
Yeah, that's absolutely true. I've been in those meetings before, and I was a younger leader, and I've been in the meetings before where all of a sudden for the volume for the quarter's down, and then the executives start to panic and say, we need 85 new LOs.
Right.
I don't care where you get them, just go get them. And you and I, Pat, in a week, you hire 85 LOs. They may not be the right LOs. So I think it has to go back to, what is the profile of a producer within your organization? And are you hiring loan officers that meet that profile? Whether it's product type, market, whether they have the right cultural fit, whatever that might be, and stick to it. And don't pressure the managers to hire loan officers just to create good activity, because history shows, you and I've talked about that, predicting the future, that the future is probably going to bear out that they won't make it.
So Greg, when you look at the total and this view, I can't tell you how many meetings I've had about this where there is this concept that you already touched upon. All right, so let's more loan officers equal more volume. That's the concept that a lot of lenders have, and they don't recognize that what you're buying are poor performers typically, and therefore it's going to be more expensive in the long run. So what are your thoughts on that? And do you have data that shows that that just doesn't work anymore?
That right there is the most profound question I think that we should be asking every leader in the industry. Is there was a quote years ago that said, a large mortgage bank that said, our market share is in direct proportion to the number of LOs we bring on board.
Right.
And that was one point in time with one company. And I think that's a bad way to look at it. I believe that other peer companies look at who you're hiring to say, is this, it talks a lot, it speaks to the leadership. Your company, if you're just churning people, bringing them on board, everybody knows it in the marketplace. And we have data to point that out. But beyond that, the operations people, the folks involved in training and onboarding, they hate it because they know that I'm going to keep getting, pardon the expression, these dumb questions because they're not learning, or I'm getting bad quality files, or I'm not getting the follow-up. And I think it tears an organization down. It certainly layers in unnecessary cost. And, you and I've talked, Pat, about the importance of efficiency. Everyone's working harder than they ever have with all the tools and technology available. So, but how do you create more efficiency or capacity to be an effective leader, to be on top of your business? You can't be spending time with half of your sales force that are probably going to move the needle an inch. Where if you put that time and energy into your future stars, that middle group, or your top producers from a retention and an expansion mode, you're going to get a much better ROI. And at the end of the day, that's really what it's about. I always say put your producers, you can put on a flag and go out in the marketplace and people will follow for that reason. You're never going to put a low producer on a flag and say, hey, look who we've hired. It just doesn't play.
Very true. I'm curious, you have data that shows for instance, the top grouping, the people that are doing 65% of all the volume? Do you track like how long they've been in the industry, or is there data that supports that what we think is the longer you're in the industry, you're going to be a top performer, which is not true? I'm just curious on what data that you might have to support that that's really wrong thinking.
That's a great question. We do have data that shows how long they've been in the industry, and that is definitely an indicator, but there's a lot of long-term low producers in the industry too.
Sure.
So I tell you, an indicator that my teams have used over the years that has really worked well is the number of job changes within 5 years. So if they're more likely to stay with a company because markets change and companies' direction changes, but if they're emotionally connected to a company, they're more likely over time to be a top producer. But if they change every year looking for that bright object, that shiny object, our history would show that they're not going to be as successful long term, and that's somebody that I probably would pass on in hiring them. But absolutely, there's definitely truth to it. But you know, you and I talked the other day, Pat, about this, and I think it's totally true. Every loan officer today at the top of the chart started somewhere, right? They didn't start as a top producer. There's something that they did or doing, or part of who they are as a part of their DNA that drove them to high levels of performance. So it's okay to hire people that aren't necessarily the highest producers, but it's digging deeper to find those right behaviors and the right tenacity and all of the skills, personal skills and follow-up skills that would indicate they have the ability, the skill set to grow. There are some companies that, and again, I don't know, this is probably not the right market for it, that are going out to it and saying, let's bring on some new folks to the industry that are successful in other aspects of their career or school or whatever. And let's teach them the business, provided they have those right behaviors and dimensions and so on. And then you're not dealing with, pardon the expression, retreads. You're dealing with somebody who's excited to come into the business, but the company has to stick with them for that, what do you think, Pat? 1 year development period, maybe longer?
Well, they'll develop and show it quickly within the first 6 months. I mean, I see students all the time, but I agree with you 100%. There's holding on to more experienced people that are underperformers than have had a longer track record of being underperformers. These people will increasingly get better. It leads me, Greg, to you posted recently on LinkedIn regarding that the bottom 50%, the likelihood of them ever moving differently never happens. And I love that comment, so I want to hear you share your thoughts on that.
Thank you. I have had more feedback on that, more DMs on that, both in favor or against that comment. And the comment was, a low producer will always be a low producer.
Right.
Prove me wrong. And I know there are some folks out of that group that have been able to achieve, and there may have been something going on in their personal life that took them away. You know, they were distracted, health issues, whatever. That's different. But if you go back to a success history, you can see that success tends to be a trend. It's not a peak and valley. You're successful in school, successful in sports, successful in previous jobs. But I rarely ever see the low producers break out of that. And I tell you why, and it's very simple. You know, what I said earlier was I want to micromanage their activity to make sure I get a full commitment from them. And then we'll work on skill set if I know they're committed and they're out in the field trying to make relationships, but for whatever reason, they can't overcome objections or they're too new, whatever. You rarely ever get loan officers that get there. Most of them will fail in the activity side of it. But those that don't, those that say, hey, Pat, you've given me an action plan. If I follow this action plan for the next 90 days consistently, then you know they're committed, and then you can work on development and skill set. So I still stand by that. And yeah, there are some unicorns, but I think it's a rarity, but it certainly is probably 10% of that bottom group at the most.
Well, I agree with you 100%. And so I'm with you on that topic. I see it all the time in training classes. We only have a couple minutes left. Any thoughts that you'd like to share with our listeners today?
Absolutely. And again, I manage differently, I think, and I've been blessed with amazing people that have either made me look good or taught me a ton. So I want to say thank you to everyone that's been on my team. You made me better. But to me, it's a matter of if you follow a proposition with the loan officer that it's not 50-50. They don't own 50% of the success, and you as a leader own 50%. It's at least 51-49. They got to want it more than you do. And if you find those folks that are willing to put in the time and energy, and you work with them as a coach on their a goal and the activity, and it's not punitive. It's not, everyone says, well, if I'm managing their activity, they're going to be upset, and it's micromanaging. You only micromanage people that aren't doing the job. You don't micromanage somebody who's successful. So I would say change the mindset a little bit and think of yourself as a fitness coach. If you want to engage a fitness instructor or fitness coach to run a marathon in the next year, and you show up at your first training session with a donut in your hand, there's a point to where you go, wait a minute, do they want it more than I do? Mm-hmm. And if they don't, I don't think you're going to get out of whatever first base or whatever that is. So I think it's a matter of hire people. If you hire them, you're responsible to help them be successful. But they're 51% of it, you're 49. Once they're on board, show them the love, help create an emotional connection to the company and to you as a leader, and then I think great things can happen.
Well, I love, Greg, all that you're saying. It's really aligned to certainly what I see every day, and I appreciate you sharing all your wisdom. I want to thank our listeners for listening to our podcast today. You certainly can catch up on all our episodes at patsherlock.com and subscribe. Thanks so much, Greg.
You got it, Pat. Thank you so much. Nice working with you.
Thanks for listening to Mortgage Manager Playbook. You can catch up on all our episodes by subscribing to receive each week a new show. Don't forget to share this podcast with your friends and team members. If you're looking to increase production, call me to discuss my prospecting sales training program, Ramping Up Realtor Referral Sources. Check out my website, www.patsherlock.com.